Okay, manager attribution. Here what we're looking for is your client comes to you again, but this time they say, hey, I have a mutual fund that invests in just one asset class. Large cap value, small cap growth, whatever. I'm thinking about using this manager. Can you tell me if this person's any good? All right? You're not saying, does it have the right allocation? You're just asking, is this manager any good? So you told me I need 12% of small cap value. Here's a small cap value manager I've been using. How good has he or she been performing? All right? So it's a little bit different question. So here you're going to pick a mutual fund again, but you want a mutual fund here that only has one asset class in it. You're going to do very much the same thing we did above, though, in bringing the values in. So I'm going to do another one. I've been doing several of these. Boy, see if I can find one. Fidelity. Let's try the blue chip growth. I don't know anything about that one. Let's do max. Goes back to 87, so 12/31/87. Right, that's pretty good because that's exactly what mine is. Anybody know this one? Blue chip, whatever. All right, so I picked a fund, and it looks like it has enough history. I'm going to look at the profile for this fund. I'm going to let Morningstar tell me what kind of fund is it. So what does Morningstar say this fund is? It's a stock fund, right? What kind of stock fund is it? Is it large cap or small cap? Large cap, value growth, or core? Growth. So large cap growth, so what are you going to use? You're going to use the large cap growth indices. Now, that means you bring in the benchmark to large cap growth. You might also bring in the S&P 500 depending on if you're going to do a Jensen or a Trainer, because Jensen and Trainer need beta. Beta is always against the S&P 500. So you might have to bring in two pieces of indices. But we'll figure that out because I'm not going to do Trainer and all that in here. I'm going to let y'all figure that out on your own. Right, so I'll go back to historical data. Nothing happens. We'll do the max. Monthly. Bring that in. The exact same thing I did before. Get rid of everything but the adjusted close. Get rid of the first month. Go down to the very end and get rid of April. I'm going to copy and bring those over. And I'm going to create a whole new page. And on the third line, I'm going to paste those values in. I'm going to put the ticker there on top so I know what fund it is. I don't remember what it was. FBGRX. Let me bring the whole thing in. It's going to be a little wordy, but
We delete the first and last date, okay?
yeah, that's always the safest. I'm going to bring that over. And here I'm just going to start using this ticker, FBGRX. And now I'm going to do FBGRX return. How do you get a return? Well, I'm going to change the format here. I'm going to change it to commas so it doesn't look so. So how do you get a return? You can't get a return for January because you have to have a beginning value. So to get a return, you take plus the February number divided by the January number minus 1. Ending divided by beginning minus 1. So there's a return for that month. Copy that down. I'm now going to do large cap growth. So I'm starting with February 88. I just do plus, and I go over and find asset return pace values. Make sure you do pace values because the asset returns is tied to Bloomberg. You'll get a bunch of errors. So pace values. Here's for large cap growth. Here's February. See how that's February? February large cap growth. Right? I get that first month and hit enter. And then you just copy that down. And that gives you all your returns. And all my returns are lined up nice and pretty. Something you might want to do right off the bat is do the correlation of the two of them. And that I will tell you real quickly if something's messed up. Correlation is 0.9, it's probably correct. Yeah, I remember in class we had trouble with some data off, and you have to make me fix. So when I did the contra fund, the fund was trading like $8.34, $8.37, whatever, and then suddenly it was $83 point something. You can look at that and just know that they put the decimal in the wrong place, and you can fix it yourself. That's pretty easy to do. So I don't see anything like that that looks like it's. One thing you can do is you could just graph the whole thing, and if there's some major problem, you'd notice it. This looks pretty reasonable, doesn't it? Like if it went from $8 to $80, that would go off the chart. And you say, there's a data problem. Doesn't look like there's a data problem here, so it looks like we're in pretty good shape. All right? I might use that correlation here. So now I got the return for the fidelity. I got returns for the growth. So I'm going to come down to the bottom. I'm going to put up a few pieces of information here. First, I'm going to figure out how many months there are. So I'm going to do equal count A out of all those months. So I have, there's 374 months. We're going to need that for calculating some geometric averages. What else do we want? Well, let's get an annualized average return. I did this earlier today with my cell class. It was amazing. They wanted to do the USA Aggressive Growth Fund, which I knew was not a very good fund. Don't tell my USA friends that, but yeah, it was a good fund. But it was an amazing one. I'll show you what we found out there because it was really, truly pretty remarkable. So annualized average return, you just do equal average. You get the return for your fund. We're going to annualize it, so just multiply by 12 because it's monthly. There's your fund return. There's the index return. Your fund has had an average return that's about 200 basis points, about 2% higher than the index. What else can we do? We can do an annualized standard deviation. How do you do that? We'll just do equal STDEVP. Select all the data. How do you annualize standard deviation? First do 12 times 12 square root of 12. So there's your standard deviation. There's the market. All right, so this fund has a higher average return in the market, but also has a higher standard deviation in the market. What else can we do? We'll go back up to the top, and we're going to bring our fund over and the growth over, and we're going to start them both at $1. And we're going to link these returns. So you take $1 times 1 plus the first month's return. Do the same thing with the S&P. The previous cell times, up parentheses, 1 plus the return. You're essentially just going to link these returns over time, all the way down. And when you do that, you can see, boy, it's a huge difference. You can see that if you had $1 invested in the Fidelity Fund, you'd have $32 a day. If you put it into an index fund, you'd only have $18, $19 a day. So you can see how much better that fund has done than the index. But you're also going to get an annualized geometric return. So hopefully you remember this from your investment class. Annualized geometric return. There what you do is you take that ending value and raise it to the 12 divided by the number of periods and lock in the number of periods minus 1. Hopefully you remember that formula. And that gives you the geometric average return, 11.8 versus the market's 9.9%. This is a very good fund. I'll show you the USA one here in a second. So hopefully you remember after the investment class, you geometrically link them, you take the last number, raise it to the 12 over the number of periods, minus 1, and it gives you your geometric return. It also is going to give you the alpha, because we calculate alpha off the geometric return. So you just take your fund's return minus the benchmark, and you can see that their alpha is 1.9%. right, so number of periods, annualized average return, annualized standard deviation, geometrical return, that gives you an alpha. The next thing we need to do, we're actually going to calculate the monthly alphas. The monthly alpha is just your fund minus the index, and you just copy that all the way down. So how did they do? And that's going to give you tracking error. Anybody remember what tracking error is?
Standard deviation between the net alphas. Standard deviation.
Deviation of the alpha, right? STDEVP of the actual alpha itself. But you don't annualize this, all right? You don't annualize it, you just take the number. Information ratio is kind of strange when we do information ratio. The information ratio is the alpha divided by the tracking error. However, the alpha is annualized, but the tracking error is not annualized. All right? I don't know why that's the case mathematically, there may be some reason for that. So there's our information ratio. 0.89 is pretty good. Above 1 is very strong, but 0.89 is a very good information ratio. In fact, it's rare to see anything. I don't know why they say 1's good, because it's rare. I think it's a t-statistic. If you remember your stats class, a t-statistic, if you're above 1, you can say, hey, it's not random chance, there's actually something going on here. That's the thought with the information ratio. If it's above 1, you go, hey, there must be skill here. They're not beating the index because of some random noise. They actually have skill. So it's kind of a t-statistic. I will tell you there's been no indication that information ratio is actually a good way to pick managers. So it'd be nice if it were, but there's no indication that it is. All right, so there's the information ratio. What else are we going to do? Let's try batting average. So batting average, all you got to do for batting average is an easy one. You just ask if the alpha is greater than 0, give me a 1, otherwise give me a 0. You're just going to count how many months that they beat the market. You might say, well, that's just way too simple. This actually has a better predictive value to it than information ratio. I don't know why, but it does. Or at least it was the last time we tested this. So the batting average, you just take a sum of the number of months that they beat the market and divide it by the number of months. You can see their batting average is 53. If it was random noise, you'd expect it to be 50% of the time. So they do slightly better than 50% of the time. That's pretty good. And then the last two you want to do is the upside capture and the downside capture. This one's a little bit more involved. So we're going to look at up markets. We're going to look at down markets. And we're going to look at our fund and the index, and our fund and the index. So what is an up market? An up market is not when the fund is up. An up market is when the index is up. All right? And a down market is when the index is up. So we're going to say if the market is greater than 0, then give me the fund's return. Otherwise, two quotes, give me nothing. Same thing with the market. If the market is greater than 0, give me the market. Otherwise, give me nothing. Don't say 0, because we're going to be taking averages. We need to make sure there's nothing in that cell. On the down market, we'll say if a market is less than 0, give me the fund. Otherwise, two quotes. Same thing with the market. If the market is less than 0, give me the market. Otherwise, two quotes. I'm going to change these to percents, copy them down, and you should never have a whole row that's blank, and you should never have a whole row that's completely full. The only way you can have them all be blank is if somehow the market got exactly a 0% return, and that's pretty unlikely. It is possible to have negative numbers in this column. Why? Because the market was up, but the fund was down. We still want to count that as an up market. And it's possible to have, well, here's a 0. I don't know if exactly 0. Yeah, there's exactly 0 right there. The market was slightly down, they got 0. I don't know if there's too many where they have a positive. There's one, they have a positive return, market's down. All right, so you have all of those, and all you gotta do is go to the bottom and just do equal average. And copy that across. And so an up market capture is real simple. You just take their average in an up market divided by the market. The down market, you take their average in a down market divided by the down market. This fund looks, man, you also gonna put some money in this fund. This fund, when markets are up, they capture 105% of that. That's good. When markets are down, they only capture 96% of that. That's good. So this is a really good fund. Yeah, this is a really, really powerful, strong fund. What else could you do? Well, there's the Sharpe ratio. You got the trainer. You got the Jensen. I'll let you all look those up. If you do the Sharpe ratio, you have to bring in a risk-free rate. I actually brought the risk-free rate in over here somewhere. 30-day T-bills. I did that by going to age 15 on the internet to give me the St. Louis Fed. You have to click around. It took me a while to figure out how to get monthly T-bill returns, but you can get them. They'll give you an annual yield, so you just got to divide it by 100 and by 12 to get a monthly, and that just becomes your risk-free rate. So you can see how I'll set that up in here and did that. So that's the Sharpe ratio. The trainer and Jensen, those both require to have a beta. To get the beta, you got to bring the S&P 500 in and calculate, or just calculate the beta of this fund against the S&P 500 and put it in there. Because what they're asking is, if my beta is, and we can do it really quickly, excuse me. Beta is very easy to do. You just do equal slope. You've got your fund going from February 88. And you just go find the S&P from February 88. And there's your beta. So what this is saying is, okay, well, great, your return is higher, but you also have a beta above 1. Now, this fund actually could argue our beta is above 1, but actually we do better in up markets and we're safer in down markets. So you could say our beta is shifting over time at the right pulse time. We have higher betas in good markets, we have lower betas in bad markets. So don't even look at our beta over time. But the do Jensen, I'll let you look those up. So I recommend get at least one of them in there. You almost never see Sharpe except for in hedge funds. And I have to admit, I've never seen Jensen and Trainer in real life. I think it's because y'all know betas are so unstable. I think that's part of it. People just don't trust the math. But try one of them, look them up. They're so easy to do. You can just look them up and do the math. They're very easy formulas. You should know them for the CFA exam, and then you can forget them after that for the most part. But hedge funds do use Sharpe ratios. Sharpe ratios, if you get a Sharpe ratio of 0.7, it's completely meaningless unless you compare it to other funds. So in this case, it's not meaningless because you only have one fund. Say, well, my Sharpe ratio is 0.7, well, one of your competitors, oh, they're 0.9. Okay, well, you didn't do very well. So Sharpe is asking how much return over the risk-free rate are you giving per unit of risk. It's just your return minus the risk-free rate divided by your standard deviation. A very easy number to do. All right? So that's the project. Any questions up to there? This went, well, last night it took an hour and a half, tonight it only took an hour because we weren't fixing Excel problems. Let me show you the one we did earlier today. I'm going to turn the video off. YouTube.